Let's talk about the shilling for a start. Yeah. We see the shilling always taking a dip at the end of the month, so we're not too worried about that. But what are your thoughts on the shilling?
I think the shilling is going to be maintained stable where it is at right now. The central bank has managed to have it at those levels based on what they've been doing, particularly through the intervention. And they normally have sales every other time, as well as the high interest rates that have supported sort of dollar inflows and kept the shilling where it's at right now. So we expect for it to trade stable, between 83, 85 range, probably for the next 3 to 4 months.
Because in the last week, or actually most of the last 2 weeks, it's been around 84, so it appears to have stabilized around that zone.
Yeah. I think that's actually very supportive of where they want the shilling to be. I think if you looked at what happened in January and a bit earlier on in the year, there was actually room for the shilling to strengthen further towards the 82 and 80 mark, but the central bank actually took deliberate actions to keep it within those levels. So it does look like they've established a bit of a band or some sort of rate that they feel comfortable with, both to support their exports and to, sort of mitigate against inflationary pressure coming in from the sort of imports that we normally have to get in for fuel and some food items. So they feel comfortable with it at about that level, and I believe they have the firepower to support it there as well.
And speaking of the central bank, the Monetary Policy Committee meeting next week, and some analysts, let me guess, what do you expect the Monetary Policy Committee to do?
Well, they're obviously going to cut. I mean, I feel strongly that that's the direction that they will go, just based on 1 or 2 actions that they took last time, including extending the sort of timeline between meetings. So the sort of effects that they had last time are supposed to have fed through into the system. I think we see inflationary pressure coming down. We might see this month's numbers come down to between 6.4 and 7%, or just fairly lower even. And all that would be supportive of an interest rate cut to sort of get the economy back to where it needs to be.
There seems to be consensus at this point that the central bank's MPC will cut rates. But how steep? Where would you expect them to cut it? 150, 100 basis points, 200?
Yeah, we've done some work a bit early in this year, and we said that we thought that the optimal central bank rate as a policy rate would be about 10%, which would be supportive of sort of credit growth. At the same time, have inflation probably within that target of 9% that the central bank has been targeting for the longest period. So now what we think is that probably means that there'd be about 650 basis points of cuts coming up. Now what we think they'll probably do in the next meeting, they might be a bit more conservative, because you don't want to take your foot off the pedal too much. So they might actually do anything between 100 and 150 basis points.
150, very conservative. One analyst we spoke to yesterday, Ali Kansacho, expects as much as 250. 250 basis points. Too aggressive?
I think you'd probably want to look at 2 things. 250 basis points, it does make sense from the point of view that the economy has slowed down significantly. If we look at a lot of the leading economic indicators that are coming out from the Bureau of Statistics, we're seeing real estate activity slowed down. We're seeing a bit of, while the current account balance has improved somewhat, a lot of the farms are not really going into capital inventory, and that's affecting fixed capital formation. We're seeing a bit of a slowdown, and we expect the numbers, quarter 2 GDP numbers, to come in much lower. So that would inform a rate cut, sort of stabilize the economy and actually get back to more aggressive growth rates in line with the Vision 2030 plan. So 250 basis points, I think they might want to be a bit more cautious. It would certainly be a surprise, but again, it would be a welcome surprise if that were actually to happen.
All right, let's move on to something a bit more worrying. These clashes we've seen in the coastal part of the country. We had clashes in Tana River, and just yesterday some violence broke out in Mombasa after the shooting down of a cleric. What is the likely impact on this on the markets?
The likely impact, should probably want to look at it in terms of who is playing the markets right now. Traditionally, since January rather, up until about April, May, we are seeing a lot of foreign investor activity. And when foreign investor activity dominates local investor activity in the foreign markets, 2 things you have. Number 1 is you have a high correlation of the markets with what's happening globally. And number 2, you have a more sensitive sort of reaction based on the sort of risk factors that emerge, such as what we're seeing right now. Over the last couple of weeks, I think we've started to see local investors coming back to the market. So I would say 2 things would probably happen. Number 1 is that there's normally a bit of a lag in between when this happens and when you would expect to see a sell-off, if indeed you were expecting a sell-off. And number 2, local investors might actually be starting to come in and support. So in the event that we will actually see foreign investors getting jittery and selling off, and with the theory that local investors are more aware of what's happening in the ground and being probably more supportive of local stocks, we might actually see sort of flat trading and a lot of that ratio, that skew changing with local investors participating more.
Because the risk of these things is always that it tends to create the impression, real or imagined, that there's too much uncertainty around the country and the political risk or economic impact of that, and investors don't like this kind of uncertainties.
Yeah, you're right, Larry. I mean, political risk is actually very big. It's a very big factor when you're doing your pricing models,
yes,
when you're coming up with your cost of equity and all these other sort of inputs that go into determining where actually value is to be had. I think for the most part, foreign investors are usually very jittery. If you look at the sort of markets that have actually, in countries that have experienced some sort of disturbances or upheavals, I'd point out Nigeria and Egypt. There was whenever the flare-ups were in the north in Nigeria, and when you had that political uncertainty in Egypt, there was a massive sell-off and a lot of foreigners exiting those positions. But at the same time, in the event that that was actually it would unfold positively in the long run, because these solutions are always locally available and they sort out their issues anyway, then the market tends to rally as investors who had sold out now come back to the market. So we don't think that it's really such a big deal at this point in time. Of course, we're keeping an eye on what's happening, especially in view that we're having elections next year.
Right.
And this would actually be sort of, it might influence decision making in terms of what do we think going to happen on the ground and how are investors going to react to that. So not necessarily the sort of best thing that you would expect to happen for the markets right now, but keeping an eye on it all the same.